Welcome to our CFP exam prep discussion on universal life insurance. Today, we're diving deep into this flexible, permanent life insurance product that often appears on the exam, and I'll help you master the key concepts and avoid common pitfalls. Let's break down universal life insurance into its core components. Universal life combines life insurance protection with a savings component, but what makes it unique is its flexibility. Think of it as a two-bucket system. The first bucket holds the cost of insurance and administrative expenses, while the second bucket contains the cash value component that earns interest. Understanding the premium flexibility is crucial for the exam. Unlike whole life insurance where you pay fixed premiums, universal life allows policyholders to adjust their premium payments within certain limits. You can pay more when times are good and less when money is tight, as long as there's enough cash value to cover the monthly costs. This is a key distinction that exam questions often test. The death benefit in universal life can also be flexible. Policyholders can choose between two options. Option A keeps the death benefit level, while the cash value grows within the policy. Option B adds the cash value to the face amount, creating an increasing death benefit. The exam frequently asks questions about these options and their implications for policy costs. Here's a practical example that often appears in exam scenarios. Imagine a policyholder with a $500,000 universal life policy using option A. If the cash value is $50,000, the death benefit remains $500,000. However, with option B, the death benefit would be $550,000. Understanding this calculation is essential for exam success. Let's talk about the interest crediting aspect. The cash value earns interest based on current market rates, but there's usually a guaranteed minimum rate. The exam might present scenarios where interest rates change, and you'll need to understand how this affects the policy's performance. Now, let's address some common mistakes students make on the exam regarding universal life. The biggest misconception is confusing it with variable universal life. Remember, universal life typically invests in the insurance company's general account and provides a guaranteed minimum interest rate. Variable universal life involves separate investment accounts and market risk. Another frequent error is misunderstanding the relationship between cash value and premium payments. Some students assume that as long as premiums are paid, the policy stays in force. However, if the cash value isn't sufficient to cover the monthly deductions, the policy could lapse even if premiums are being paid. The exam often includes questions testing this concept. The cost structure is another area where students stumble. Universal life has transparent costs. Mortality charges, administrative fees, and surrender charges are all clearly disclosed. The exam might ask you to calculate how these costs affect the policy's cash value or to explain their impact on policy performance. For exam preparation, focus on understanding how premium flexibility works in practice. Know how to calculate minimum premium requirements and how changes in interest rates affect the policy's performance. Be prepared to analyze scenarios where policyholders make premium adjustments or change death benefit options. Remember that universal life insurance questions often require multiple steps to solve. Take your time to identify all the components in play: premium payments, cost of insurance, interest rates, and death benefit options. Working through practice questions with these elements will help you build confidence for the actual exam.